Welcome to this latest video in our series on trading the failure of key reversal patterns, which is a more advanced series and requires some discretion. In this video, I will discuss how to trade the failure of the head and shoulders reversal pattern. Hello, I'm Fawad Razaqzada, market analyst with Think Markets. If you haven't already, make sure you subscribe to our YouTube channel in order to get notified when we add new video content. In the previous series, we discussed key reversal patterns, including the head and shoulders. But what we didn't discuss is how these reversal patterns can sometimes fail to work. While failure of reversal patterns can be frustrating, spotting and trading the failure can sometimes offer much better tradable opportunities. This is because it is likely that a large number of people would have probably seen and traded the same thing, but now that they are trapped, we can have a very good idea where the market is likely to head to. That is where the trapped traders' stop orders would be resting. So this is how a normal head and shoulders top pattern may be formed. And in normal circumstances, when price breaks through the neckline of head and shoulders pattern, then it will confirm the completion of the reversal formation. However, if price refuses to go down, then that's when you should pay attention to a possible failure of the pattern. So here you can see that price has refused to stay below the broken neckline, and it has started to climb back above that level, which is really providing the first signal that the sellers are getting trapped in this case. Price then creates a bullish reversal in the form of a break above the most recent high, and now the sellers are in real trouble. And what happens next is that as the sellers become trapped, what you will often see is an accelerated move in the opposite direction as the prior selling turns into buying for a head and shoulders top, and prior buying turns into selling for a head and shoulders bottom formation. So the target is then the area of liquidity resting above the right shoulder area, or in some cases the head of the pattern. That's where the buyers would be aiming for as their objective targets. Similarly, the opposite for a head and shoulders top pattern is the bottom, and in this case what happens is price breaks the neckline but fails to hold above the breakout area, and then it starts to break down, trapping the bulls before going down to take out liquidity that would be resting below the right shoulder area or even the head of the formation at some later point in time. So now I'm going to show you a few examples of how a failed head and shoulders pattern would look like on the charts, and I'm going to start off by looking at this euro dollar daily chart. Now, as you can see, the euro dollar was forming this head and shoulders reversal pattern in the summer of 2017. So what happened is that price completed the head and shoulders formation right here when it broke the neckline, and at that moment in time things were looking quite bearish. However, there was very little follow through in the downside, and soon price went back above the broken neckline, providing our first indication that the sellers were getting trapped. Then all of a sudden we break above the right shoulder area, where price should really never have gone if it was still going to go lower. This is where a lot of people get into trouble, thinking that this is just a short-term deviation. But what happens is that each time price goes down, it just creates more and more traps for the sellers who have not realized that the tide has turned against them. Sure enough, price then goes aggressively higher and then takes out liquidity above the head of the head and shoulders pattern right here before extending its gains. Here is a 4-hour chart of the dollar CAD showing a potential reverse head and shoulders pattern, with the left shoulder being here. This is the head and this is the right shoulder. Now price goes up here, breaks through this neckline, and so far it's looking bullish. It looks like price is about to turn higher and a new bull trend is about to start. However, what happens is there isn't much momentum to push rates significantly higher. As a result, the breakout fails here. Price then goes back inside the existing range, eventually breaking below the low of the right shoulder area. Now at this point you can start looking for short setups. So one of the ways you could then look for short setups is by highlighting levels where support should have come in. For example, this level right here, you see this hammer candle, the rounded retest of that should have held. It provided a small bounce before prices broke down. So once price comes back to this level, you could look to sell into that using the most recent high as your invalidation level. Price consolidates here before breaking down. Another way to get on board would have been to wait for a break below the head of the inverse head and shoulders pattern, and you could have literally sold short the breakdown of that. If you prefer to wait it longer for further confirmation, then you would have got plenty of other opportunities. For example, trading this level here, price forms support, breaks down, comes back up, rounded retest, and then goes down again. Another entry would have been right here, this level. Price breaks through this line, forming a large bearish engulfing candle, goes lower, comes back up, retests it, and then drops. Similarly here, price goes up, breaks down, comes back up, retests it, and then drops. And so on. Support, turns resistance, and then down we go. So it all started from that failure of the head and shoulders pattern. After that failure, we have shown so many examples, which is why you don't need to rush and enter on the first signal. You can always wait and look for better opportunities at a later point in time.